Introduction: Understanding Income Reporting on Credit Card Applications. When applying for a credit card, one of the key components that determines your eligibility is the income figure you report. Many applicants, however, find themselves uncertain about what constitutes income and whether their reported income will be verified. This report addresses these common concerns and offers insights into what should be disclosed on a credit card application, as well as the legal consequences of misrepresenting income. Whether you are unsure about what to report or considering inflating your income, this guide will help clarify the process. Footnote: This section provides an introduction to income reporting on credit card applications and the potential issues surrounding it. Legal implications of misreporting income. Misreporting income on a credit card application is a serious offense. While credit card companies typically do not verify the income you report on an initial application, they reserve the right to request verification if you subsequently request a credit line increase or apply for a business credit card. Falsifying income, however, constitutes fraud and can result in significant penalties, including heavy fines, up to $1 million, and potential jail time. Although the likelihood of such extreme consequences is low, the repercussions of being caught in a lie can include a damaged credit score, a higher likelihood of future credit denials, and potential criminal penalties. Therefore, it is imperative to always report income truthfully to avoid legal and financial risks. Footnote: This section outlines the legal consequences of misrepresenting income on a credit card application, emphasizing the seriousness of fraudulent actions. What constitutes income? There are several scenarios in which applicants are unsure about what constitutes income. This ambiguity typically arises in two situations: first, when an individual's income comes from non-traditional sources, such as financial support from family members, and second, when an individual considers inflating their income to improve their chances of approval. It is crucial to differentiate between what is legally considered income and what might be considered an overstatement. For example, students often question whether they can count money provided by parents or guardians as income. Generally, if money is being deposited into an account regularly for your use, it may be considered income, provided it is consistent and intended for your financial benefit. Footnote: This section clarifies what constitutes income, including non-traditional sources such as parental support, and provides guidelines for reporting income truthfully. Disputing misreported income. If your income is about to change, for instance, if you anticipate a significant increase due to a new job, credit card companies will generally accept your projected income as long as it is an honest estimate. Similarly, if you are a student or stay-at-home spouse receiving financial support, most credit card applications allow you to report shared income from a household member. However, discrepancies often arise when applicants inaccurately report income or fail to disclose that their income is dependent on external support. It is essential to ensure that all income reported is verifiable and consistent with your financial situation. Footnote: This section explains how to handle income changes, such as a new job, and the importance of accurately reporting shared income, particularly for students or stay-at-home spouses. Inflating income, consequences and risks. Inflating your income in an attempt to secure a credit card or a higher credit limit is illegal and can trigger serious consequences. Credit card companies rely on your financial history to assess the appropriate credit limit, and discrepancies between your reported income and your actual credit history can lead them to suspect fraudulent behavior. In such cases, they may request income verification before approving a higher credit limit or loan. Furthermore, if you are approved for a credit limit based on inflated income and later fail to make payments, this could trigger a more rigorous income verification process and possibly result in the closure of your account, damage to your credit report, and difficulty obtaining credit in the future. Footnote: This section highlights the risks of inflating income on a credit card application, including potential credit card denial, account closure, and damage to your credit history. Considerations for students and non-traditional income earners. For students and individuals with non-traditional sources of income, it is common to face challenges when reporting income on credit card applications. While some companies, such as Capital One and Chase, explicitly state that students can count regular financial support from family members as income, others may not offer this option. If you are a student or a non-traditional income earner, you must carefully read the application's fine print to determine whether your support qualifies as income. Even if it does, be prepared to justify your claim if asked for verification, and understand that some companies may be more flexible in accepting such income than others. Footnote: this section addresses the considerations students and non-traditional income earners should keep in mind when reporting income, highlighting variations in credit card company policies. Final considerations and best practices. The most important aspect of filling out a credit card application is honesty. If you are uncertain about what constitutes income or how to report it, it is better to be cautious and provide an honest estimate rather than inflate the figures. Even if the credit card company does not immediately request income verification, they can flag inconsistencies in your financial history, and this could affect your future ability to obtain credit. Remember that reporting income inaccurately, while seemingly harmless in the short term, can lead to long-term financial and legal problems. Footnote: this section stresses the importance of honesty when reporting income and the long-term risks associated with inflating or misreporting income on credit card applications.